what are other issues that come up? I've got some examples. As far as further due diligence goes, as a mining company, we would follow a structured process for due diligence. So I'm a director of a mining company, and we have invested in projects, and we followed a structured approach. And companies that do invest in mining projects regularly follow a structured approach. And I'm happy to share with you and show you our structured approach, which is the FEDER 500, which is this one here. So this is our due diligence approach sheet. As you can see, it's a 20-page PDF. So there's summary up front, which is key information, findings, recommendations, general. Ownership in terms of acquisition or participation, so that's the deal that I mentioned before. Geology, sampling of ore, how that was happening, resources and reserves, if they exist. Geotechnical data, mining and processing. So all of these factors are considered, and then as far as answering the right questions goes, the FEDER 500 is a list of 500 questions that you don't necessarily need to know all the answers to before you invest, but you need to have an understanding of such issues. You don't need to understand how you think every single issue is going to work and be resolved. You just need to understand that they are issues. Because that way, when those issues come up, when those issues get raised, there's not going to be any surprises, because that's obviously, you know, the key outcome of due diligence is that there's no surprises. It's a critical activity. It takes place prior to an investment. It's multidisciplinary. It varies greatly with regards to what activities get undertaken, how those activities are undertaken, and who does them. Obviously, transactions don't take place without some level of due diligence. Due diligence is also very often personable. I haven't spoken a lot about that here, but a huge amount of transactions are obviously conducted with due diligence, but they're conducted on the basis of person A knows person B. Look, that absolutely should get taken into account, but that should not necessarily drive a transaction. Working on the timing. Which one do you do first? Do you do legal? Do you do commercial? Do you do technical? Do you do environmental? Do you do social, etc., etc.? The answer is you do a little bit of all of them step by step. It is important to have, as one of the results of due diligence, it's important to have some documentation. It's important to have a due diligence report. It doesn't necessarily have to be big and unwieldy, but there has to be something there, because we want to have a record of the work that we've undertaken. We want to have the rationale on the basis of the recommendation, not the rationale on the basis of the investment, because we hope to be investing because we're going to advance a project and obviously make money. Investing or loaning or conducting a transaction because of that reason. But we want to have a record of the due diligence. And we want to have that because we want to know the risks, the issues, and we want to understand what we could foresee, and obviously what is, if something happens, it's non-foreseeable. The purpose of due diligence is to make sure that we make the right decision, and the decision can be a renegotiation of the deal, it can be not doing the deal, it can be doing a different deal, it can be passing the deal to someone else and having them do the deal, it can be the deal not happening at all. Assume nothing, check everything, and trust no one. Probably a good modus operandi when it comes to due diligence.